Hello and welcome to the next edition of the Capital Stewards podcast. This is indeed the first video edition of the podcast because I know a lot of our listeners around the globe commented that what you really wanted to do was to see me do these things live. No, we hope that the video version makes it easier to digest some of the concepts that we talk through. We get a lot of response when we do our quarterly outlooks. I do those on video. We talk through a bunch of charts. And so I'm hoping that the video version just makes the conversation topics a little bit easier for folks to digest. So you can find them on YouTube. And then, of course, wherever you listen to podcasts. So welcome to the first video edition of the Capital Stewards podcast. In this episode, we are going to dive into Bitcoin. There's recent news around the new Bitcoin ETFs that's reignited the conversations around cryptocurrency from the past couple of years. That's also increased the price a lot lately. I hear clients and investors share a variety of perspectives on Bitcoin, from those that are using it as digital gold in case of major geopolitical and financial disruption, to those that are hoping Web3 is sort of the next big, great technology revolution and want to have an economic interest in that. So our overarching view on crypto in general is that it's an investment tool. And like other investment tools and asset classes, it should be well understood and used appropriately. And so in this episode, we're going to talk through some of the perspectives around Bitcoin that we hear so that you can make informed decisions about whether to include crypto as part of your investment strategy. So we're going to talk through Bitcoin and other cryptocurrencies and blockchain and how the coins and the blockchain are the same and different at the same time. We'll talk about investing in Bitcoin as a currency and having investment thesis around Bitcoin as a currency, talk about it as an inflation hedge, talk about Bitcoin and crypto as a safety net. And then at the end, we'll talk about the recent ETF launches using the ETFs versus investing directly in crypto wallets. And then we'll talk about lastly at the end, whether or not crypto is sort of good or bad as an investable. What's a real investment perspective on crypto? So let's dive in. All right, so let's start with Bitcoin and other cryptocurrencies and blockchain technology. A lot of investors want exposure to the future of blockchain technology, and they use crypto to sort of achieve that goal. And so, in our view, it's really important to understand what distributed ledger technology is. That's what blockchain is. It's called distributed ledger technology. And then how that's different from the individual coins. Distributed ledger technology, for those of you that aren't as familiar, it just means that instead of there being a central clearinghouse, like today in the stock market, there's a deposit clearing corporation, there's the exchanges, there's people that have a ledger of who owns what for every single company. The distributed ledger means that everyone essentially has a copy or a record of who owns what. And so you have this ability to verify that if I'm trading with you, that I own what I say I own. So that's essentially what blockchain and distributed ledger technology are. And that allows for much faster and cheaper processing. And over time, I have no doubt that adoption of distributed ledger technology and sort of blockchain in that sense is going to increase. And there's going to be significant benefits to the financial sector that would be too large for them to ignore. And so I think we will see more distributed ledger technology over time. However, there's no reason why the distributed ledger technology that ultimately that will be used to trade stocks or real estate has to be an existing cryptocurrency network. In fact, I think the most likely scenario is that the Federal Reserve, another government agency, or even a private sector exchange will create new ledgers to be used for these kinds of transactions. So remember, the stock exchanges today are private businesses, and they're incentivized to adopt new technology and to process things faster, and to move securities as quickly, as cheaply, and as effectively as they can. So the U.S. government and other agencies also monitor transactions today for criminal activity, for terrorist activity. Yes, some people will say, well, what if they impose sort of unpopular sanctions? All that's true, but there's a significant public interest in money not falling into the hands of those that wish to do other people harm. And so I think for that reason alone, the idea of sort of a truly unmonitored, free U.S. currency system or significant trading in U.S. assets, namely stocks and bonds and those kinds of things, real estate, I think that seems pretty fanciful. So I think it's more likely that the underlying technology of blockchain is used with some sensible regulation to prevent abuse and nefarious activity. Even today, you can't trade Bitcoin on the Ethereum blockchain and vice versa. There's different ledgers today, and I think the future contains multiple ledgers. And so investing in one coin is making a bet sort of on one particular ledger or one particular technology. And I think that's where, you're sort of making a venture capital risk, right? So regardless of whether you share our view or not on how the exchanges are going to evolve over time. I think it's absolutely true that investing in Bitcoin to gain exposure to the economic benefits of future technology is akin to sort of venture capital or investing in high growth technology stocks. You're attempting to pick the winning of a technology war that's going to, sort of transpire for years and years. And so even venture capital funds, by the way, that are really good at this, they struggle to do it really effectively. So if you look inside of a venture capital fund, they typically own somewhere between 5 and 15, maybe more companies in a larger fund. And they hope that they're going to hit on one or two or a small percentage of what they're investing in. The remainders are going to be 100% write-offs in a lot of cases. And so if you're investing in crypto as sort of a high risk, high reward strategy, I think you should consider investing in a diversified way with sort of a basket of available currencies and sort of understand that you're making a bet essentially that has sort of a high level of risk. Let's talk about investing in Bitcoin as a currency. So what are currencies? Currencies are stores of value that can be exchanged for goods or services. You can take the dollars that are in your wallet, you can buy things with them at the store. When was the last time you paid for a real physical good or service with crypto? Probably not recently, right? Proponents of Bitcoin will suggest that Bitcoin usage is growing, and that's true. But there's some news stories that have come out in the last year around crypto that the stores of value and the transaction value is exceeding that of Visa and MasterCard. And I think that's a little bit misleading. Bitcoin did settle more value, quote unquote, than either Visa or MasterCard in 2022. But most of those Bitcoin transactions were financial trades. They're not point of purchase transactions in the real economy buying real stuff. So a better comparison would be comparing the 8 trillion in Bitcoin transactions, against sort of U.S. stock transactions. In the U.S. stock market, we saw $44 trillion of transactions in the U.S. alone, as measured by the World Bank. And so Spherical Insights, a consortium of other Bitcoin investors, sort of pin the purchase volume closer to 1.1 trillion in the Bitcoin world versus 3 or 4 trillion for Visa or MasterCard. I'd be surprised that the Bitcoin purchase volume was even that high. So I think Bitcoin has a way to go before it's even close to any of the major network, sort of payment provider of network volumes that are out there. So I would be really cautious of using that as a linchpin of my view. So our view is that Bitcoin is not best considered as a currency. Some other characteristics of currencies, they can be easily used for transactions. That creates demand for them in circulation. People want to own US dollars because they can take it and buy things. Still hard to do that with Bitcoin. Additionally, currencies can be deposited at banks and they earn interest. Bitcoin has some staking capabilities. So if you have a digital wallet, there are some ways to sort of theoretically earn interest on your Bitcoin, but they don't generally earn interest simply by sitting in an account. Most folks that are buying Bitcoin are buying it because they believe that it's going to increase in value similar to another commodity, not just because they're going to own it, put it in a bank account, and earn interest on it. So is Bitcoin a viable currency today? Not in our view. I have serious doubts that it will ever eventually replace the US dollar or any other major global currency for some of the reasons I mentioned above about transaction monitoring. So let's talk about investing in Bitcoin as an inflation hedge, or the thesis that Bitcoin's a really good inflation hedge. So I totally understand the argument that many countries, especially emerging markets, struggle with inflation. And the idea of a global currency that could help people in those countries have a dependable store of value is a really good idea. The problem is this is not a new problem. Most people can and they do solve for their concerns around the inflation uncertainty of their local currency today by transacting US dollars. Dollars are used for large and small purchases around the world. There's a reason why most oil and other commodities trading occurs in US dollars. So the idea of solving this challenge of local currency inflation and uncertainty around what it's going to be worth is it's not a new problem that needs to be solved. What about sort of using Bitcoin or other cryptocurrencies as an investment asset to hedge against inflation? So we looked at the correlation between Bitcoin prices and the consumer price index, or CPI. I mean, if investors are buying Bitcoin to hedge against rising inflation, we should see a positive correlation between Bitcoin prices and the change in inflation. That means as inflation goes up, Bitcoin goes up, and vice versa. And indeed, there is a positive correlation between Bitcoin and CPI inflation. Except for 2022's peak in inflation, though, Bitcoin prices tend to be very slightly positively correlated to inflation as measured by CPI. So you wouldn't go so far as to say, man, this relationship is always sort of moving together, where one goes up and the other one goes up. There's some correlation, but it's fairly modest. S&P Global did some research last year, and they looked at the correlation between the money supply and Bitcoin prices, and they found a really strong positive correlation. So that means as money is printed, Bitcoin prices also increase. And you may say, well, that's exactly it, Ryan. That means that Bitcoin is a hedge against rising inflation. And that's true, but the relationship is also true of other risk assets like stocks. So when you increase the money supply, that increases all kinds of speculative investments across the economy. Stocks, real estate, any kind of speculative asset tends to increase in price. And so when you look at Bitcoin against the S&P 500 growth index, you see a much stronger correlation than you do against CPI in and of itself. And most of the time, that relationship is very positive. So that means when growth stocks go up, Bitcoin goes up and vice versa. So in our view, Bitcoin is correlated with inflation. And like other risk assets, it is a good hedge against rising inflation. But it's important that you understand that it's sort of a one-way hedge. What do we mean by that? And that kind of goes into this next point around investing in Bitcoin as a safety net. The challenge with using risk assets as an inflation hedge purely is that the relationship is one way. And that means that Bitcoin might hedge against inflation over the long term while inflation is rising. It doesn't protect against deflation during bust cycles. Like all other risk assets, the price of Bitcoin would likely fall substantially if the economy fell into a deep recession and the stock market tanked. As risk taking declines, most volatile assets usually fare the worst. So that's a very different kind of hedge against inflation than, say, commodities or gold, which would maintain some or all of their value during a sharp downturn. So while Bitcoin might protect against inflation risks, it doesn't mean that you should think about it as a safety net for worst case economic or geopolitical scenarios. And I hear this argument a lot that sort of Bitcoin is something that will protect us if sort of, everything goes to hell in a handbasket or something like that. I think the most likely outcome is if there's a significant geopolitical or financial calamity, Bitcoin's going to perform like other risk assets and it's going to decline significantly. One of the ways that we know this is by looking at Bitcoin against other assets and looking at the volatility. When we look at the level of price changes for Bitcoin, it appears to be in a category of risky assets all by itself. Historically, we've thought of stocks as relatively risky assets compared to bonds and money market funds. You can see on the chart that while the S&P 500 grows over the long term, it moves up and down significantly over shorter time periods. And if you've been a stock investor, you understand that. You're years where returns are really positive and then other years where they're really negative and you have to hold them over long periods of time. Well, Bitcoin and crypto makes the S&P 500 look like a calm walk in the park. On this next chart, you see the extreme levels of volatility, and it makes it look like a bond or a money market holding because it is so volatile when you just look at it on the chart. So Bitcoin has significant volatility, and that's part of why we view it as a sort of a high risk asset as opposed to a sort of safety net asset that you would use in a portfolio to protect against sort of tail type economic and geopolitical scenarios. So let's talk a little bit about the ETFs. Those have been in the news lately. We've seen significant price increases because there's new ETFs, and that makes it easier for folks to invest. The way that those things work, investors buy shares in the ETF. The ETF providers, so like your BlackRock and Fidelity are the two sort of major ones that have come to market recently. They work with another custodian like Coinbase, and then Coinbase goes and they purchase the actual crypto holdings and they hold those in a trust that's tied back to the ETF. So investing through the ETFs provides easier administration and more security than investing in the crypto wallets. You can trade them through your brokerage account, right? It's as easy as buying any other stock or bond. And the big benefit, I think, is your funds remain with a well-known custodian. They can reset your password if you forget it. And for all those privileges, the ETFs, they charge a small fee. The crypto exchanges come without the management fee of an ETF, but they require you to own and manage your own digital wallet. And some of you may be familiar with this, but if you lose your wallet credentials, you might lose your tokens for forever. So there are some real challenges with holding your own crypto natively yourself. And in addition, while the exchanges don't really charge management fees, crypto exchange transaction fees tend to be quite high. And so from a fee perspective, that's going to offset some of that management fee that you see in the ETF. So in our view, the trade-off between the ETFs versus direct investing is really your penchant for easy administration through large financial institutions with the ETF approach versus sort of the anonymity and special features like staking of direct crypto wallets. If you're not a really savvy crypto investor, then maybe the ETF makes more sense than investing directly. But the ETF, just like any other investment structure, and I think this is a really important point, is simply a legal structure for an investment. the investment still needs to be worthwhile on its own. Just because it's in an ETF does not mean that it is a good investment. So the advent of the ETFs doesn't change any of the crypto fundamentals that we've laid out so far in this episode. Not every ETF is a good ETF to own. So is crypto investable? Is it good or is it bad? The point of this article is not to pass judgment on crypto or on Bitcoin. It's not good or bad, but it should be used in the right circumstances. You shouldn't use a hammer to hit in a screw, and you can't use a screwdriver to turn a nail, right? Bitcoin is a tool, and it's got to be used appropriately. So what do we think is the sort of right set of circumstances? I think sort of all in, I think it's best to compare Bitcoin to high risk venture capital like commodities or collectibles. It does not have a high cash flow or economic value outside of investor demand for the asset, sort of similar to gold. However, it does have a lot of volatility and correlation with other high risk assets. You should not think of it like a safe haven asset. I think instead, Bitcoin should really be used by investors with a really high tolerance for risk and in a small portion of your portfolio, kind of similar to the way that you would think about venture capital. I would suggest investing no more than you're prepared to write off as a total loss. Some will argue that crypto makes sense as part of a portfolio because it's highly correlated with other common assets like stocks or bonds. And that's true. However, an investment with the high volatility of Bitcoin, because it's so volatile and it moves up and down so much, it's naturally going to have a low correlation to just about any other financial asset. There isn't anything else in the world that moves up and down with that level of volatility. And so just because it moves up and down wildly, which reduces its sort of correlation, and you can do some financial math, Sharpe ratios and portfolio math that makes it sort of seem attractive in a portfolio, that does not make it a worthwhile investment on its own. It still needs to stand on its own before you think about considering putting it in a portfolio. So for most long-term investors that are looking for consistent mid to high single-digit returns, the risk-reward profile of Bitcoin seems unnecessary to me. However, I know there's folks out there that want to take larger risks. So Bitcoin might have a place in your portfolio. Crypto might have a place in your portfolio if you're looking for sort of a higher risk, higher octane kind of strategy. Full disclosure, we don't recommend cryptocurrency investments to clients, but if you choose to invest, I hope that you do it with the right perspective of Bitcoin as sort of a high risk venture capital like commodity, and not maybe some of the other types of comparisons or sort of things that you hear out there about Bitcoin. So hopefully this episode was helpful in thinking about Bitcoin, thinking about cryptocurrency and everything that's been in the news, and equips you to be a smarter investor when you think about cryptocurrency and your portfolio. If you want to learn more about this topic, there's an article on our website that we wrote that is a companion to this. So you can see the charts again there and dive into some of this research in more detail. And we look forward to talking with you more down the road.